Hey traders, this is Ron Haydat Market Tamer. Happy Monday. Hope you guys had a great start to your week. As always, nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and specific financial issues shall always be addressed by your financial advisor. The markets were basically up today, SPY, diamonds, Qs. The bulls remain in charge. So let's talk about some stocks that I've gotten some questions on recently. First one is Boeing. They're due to report. And the thing with Boeing is there's some resistance or top up here at 400, some support at 340, 60 buck range, 15, 20% range. But anything can happen with that earnings report. But not to mention that today, reportedly, Fitch and Moody's lowered their outlook to negative. The 737s are still, the Maxes are still grounded. Who knows how this is going to play out? Investigations are now going on. Anything can happen. Knowing all that uncertainty and another earnings report, if I own the shares, I would want some protection. Now, last time they had earnings, stock didn't do a whole lot, but then it did pull back in May when the whole market sold off. So this could be a non-event, could be a big event, and then there's these outside events that could also be negative for the stock. So if I wanted to trade Boeing with a put, something I'd probably consider doing is going all the way out to January. Usually, 45 to 60 days is enough time, 90 days is enough time for an earnings report. But given all the other stuff going on with this stock, maybe something out nearly 6 months is something to consider. Stock's at $373 and at the money put cost about $2,415, $24.15 a share to protect 100 shares. What could be a great exercise is taking something like in January and then also September, coming in here at the same strike. The fate is going to be almost twice as much, so it's going to lose twice as much value on a per day basis, but it's also a lot cheaper. And then see how these options gain and lose value over the coming days and weeks after this earnings report. Because understanding how to protect capital, like the Netflix example that we're going to look at next, is crucial, I think, in trying to preserve capital. Now, with that said, let's take a look at Netflix. We talked about the big gap down back on the 18th. Friday went lower. The big target, 240-ish, maybe some support at 260. Well, what happened today is a hammer type candle. I don't really care that it's 17.7 million shares. I don't care about the number. How tall is that bar? Red bars are when the stock finished lower, black bars are when the stock finished higher. With this kind of hammer, in potentially no man's land, technically, that part I like. I don't like hammer sticks when they form at other support levels because they're not as believable. It's more of a probing effect to see what's there, soaking up supply. You get hammers where there's no support in the middle of big trading, in the middle of big moves, from resistance to support. Basically open air space. That is, to me, a much more believable hammer bottoming candlestick pattern. Okay, if I assume, just for fun, let's say this is a bottoming candlestick now. I would want to see a gap up tomorrow and it close near the highs of the day, ideally. If that happens, then this could be more believable that, hey, we have a bottom in. If I want to be more aggressive and try to catch a falling knife, which can be very expensive, i.e. losing lots of money many times, catching falling knives are usually not a good idea. But if I wanted to try it, it needs to stay above today's intraday low of 305.81. If it were to close below there, then this hammer candlestick is nothing more than a one-day relief rally off the lows. All right, Halliburton. They had earnings today with a potential trend change. Two little dojis down here, but today we get a big gap up. If we take out the closing high of 23.85, we're talking about 11, 12 more cents. There's a little gap fill up towards 25, but then the main target is the 200-day moving average. What I would consider doing now is using the blue line and 8-day EMA as a potential trailing stop, because this stock in the past has used this pretty nicely when trends develop. We're starting to see some bigger black bars come in here even ahead of earnings. Now we have one on earnings. So let's say it closed above 23.85, then the target, the big target, would be the 200-day moving average. Sticking with the earnings theme, Google and Amazon have earnings on Thursday. Just be aware that those earnings reports could change. Thinkorswim had a different date. They have Wednesday, the 24th is Wednesday on Amazon. We go to Google. They're saying today, which isn't the case. So whether it's today, tomorrow, or Thursday, different sites give you different information. The point is, whether it's Wednesday, Thursday, whatever, you can see massive volatility, just like we saw back here in May. Now, May, the whole market declined. You could say Google sort of let us there in a way with that big move down. This stock went from almost 1,300, ended up coming down to 1050. That's almost a 30% move, right? 25% move. Amazon, we look at the last couple reports, not much of a move here, not much of a move here. Maybe this one will be a bigger move. Again, at the money puts typically 45, 60, 90 days in time. So keep an eye on those. Apple has earnings next week. Still about a week away from that. Right now it's using the red line as a nice end of day trailing stop. American Express, there was a question on what would look like a trend change, because if you go back to the December massacre, stock was below 90. Now it's up at 127.50. Pretty much a straight line. The 50-day held right at the end of May, beginning of June. But now there's an earnings report out. Stock is starting to drop. Volume picked up on Friday. If it gets below the orange line, that to me would identify, hey, last time they were willing to buy it after a really nice rally already, they break that on a closing basis, the bulls have lost their edge, or the dominant trend. And then lastly, Beyond Meat was another one I got asked about. Much shorter trading history, but what would a trend change look like here? Well, now that we got some data on Beyond Meat, it opened up around 50. Now we're at 194. I mean, to me, this is insanity, but hey, maybe it goes to 1,094. Who knows, right? What I'm seeing now is once it got above the red line back in May, it never really gave it up. It never closed below it. That would be an example. You know, nothing is perfect. We could use Ichimoku, we could use Fibonacci's, we could use all kinds of stuff. Go into more of an intraday chart, but I really do love that red line. That 20-day EMA is a great litmus test we can see so far, whether it's by luck or it's purpose. They are seemingly buying it there. They're not letting it get much below it. So when that stock gets below the red line, to me, the 20-day outlook, which is essentially 1 month worth of data, is no longer bullish. It can't be if the stock is going to be closing below it. So that's it. Remember, earnings watch this week. Google, Amazon provide fireworks either Wednesday, Thursday, and we'll cover those in the nightly videos. So have a great day, folks. I'll see you in the next video. All the best.